Hey, welcome back, options traders. Happy Monday. I hope everybody had an amazing Thanksgiving holiday, and it's now time to get back into some options. And recently, I've used the term in some of the videos about having your deltas roll over on you, and that for a particular strategy, you have to be careful that they don't roll over. Phrases like that. And I had somebody that sent an email and said, what exactly does it mean when your deltas roll over? Well, it's a very good concept. Every professional trader knows about it, so it's something that you should understand too. Let's go find out what it means to have your deltas roll over. And before we do, as always, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So before we get started, quick review on delta. You can't understand what it means to have your deltas roll over if you don't understand what delta is. So delta is one of our many Greeks that we use in options trading. It's a sensitivity measure. And delta shows by how much the option's price will change for a $1 change in the stock's price. Technically speaking, we should be using very small changes in the stock's price, fractions of a penny. But to make things simple, we just say if the stock rises or falls $1, how much is that going to affect my options price? And so this is where this concept of delta is coming from. So if we have a risk graph for shares of stock, let's say purchased for 100, remember that the risk graph for shares of stock is a straight line. So that just shows that you're making dollar for dollar as the stock rises and losing dollar for dollar as it falls. So if the stock rises from 100 to 101, that's a $1 increase. What does it do for your profitability? Well, we just trace a line from the new stock price of 101 up to our risk graph, and we find that it also lines up at 1. So what it's telling you is that for every dollar increase that you get in the stock price itself rises $1. No surprises there. So all we're doing with the delta is we're just saying, how big is this change, this increase in the profitability, is $1 relative to how far the stock moved. So it's just $1 divided by $1, which is 1. So we would say that shares of stock has a delta of 1. And that's always going to be true no matter from which stock price to which stock price we move, up or down. It's always dollar for dollar. But we're going to find out that's not always true for options. So for instance, let's say that we have our stock at 100 and you buy the $100 call for 3. And your broker's platform says that its delta is 0.7. And what this means is that this option is going to pick up about 70% of that next move in the stock. So again, if we want to make it easy and generally speaking that if the stock rises $1, we're going to pick up 70% of that or 70 cents. So if the stock climbs from 100 to 101, we would expect that this $100 call is going to rise from 3 to 370. It's going to pick up again 70% of that $1 change. Now notice if this were shares of stock, we would pick up the full dollar because stock always has a delta of 1. But you can see here that that's not true. We only picked up 70% of that. Now, if the stock falls from 100, let's say, down to 99, same idea. You're going to lose 70% of that dollar change or 70 cents. So we would expect that this option, this call option, would fall from 3 down to $2.30. One of the things that makes options trading so tricky is that this delta changes. It changes as the stock price changes, as volatility changes, as time to expiration changes. It's kind of always changing. And so that's one of the reasons that we have to monitor it. So visually, delta is the angle of the risk graph that we're looking at. So for example, this is a $100 call. Looks like it was purchased for about $4 here. And at expiration, we're on the black line. So the delta is the slope over on this side at expiration for all stock prices at 100 or below is 0. For all stock prices above 100, again, at expiration is 1. It is going to behave exactly like shares of stock because if the option is in the money, again, it's a $100 call for all stock prices above 100, it's in the money. And at expiration, it is going to get exercised by somebody. And if it's shares of stock, you now know it has delta 1. But prior to expiration, you're not on this black line. You're on this blue one. This is called the current curve or today's curve. And so if we want to know what the delta is, we can't really measure it across the entire range like we can for shares of stock because it's not a straight line. So instead what we have to do is to look at two very small points. And so we might look at, let's say, a price of $90 and $90.05. Again, a really small range, technically even smaller than that, but you get the idea. And we're just going to measure that line because if we make that segment really small, it's going to be, roughly speaking, a very straight line. And so we might measure it and say, well, the delta in this very small range is 10. It's behaving like 10 shares of stock. Maybe up in this range, we might find that it has a delta of 30. We're starting to get a little steeper. Up here, it might be delta 50. Call option goes more in the money. It's going to be maybe delta 70. And only when it's very deep in the money, prior to expiration, will it ever reach delta 100. So put options work exactly the same way in the opposite direction. So up in this range, we might see a delta of negative 10. Remember, put options have negative deltas because they're behaving like short shares of stock. And in this range, we might be delta negative 30, delta negative 50, way deep in the money here, eventually delta negative 70. And only when this put option becomes very deep in the money will it ever become delta negative 100. But it's the same idea that these numbers, forgetting about the minus sign, are getting bigger, going from 10 to 30 to 70 and 100 as that put option goes deeper in the money. So this is the whole trick to understanding what it means when deltas roll over. We are, depending on the strategy, going to flip from positive to negative, even though that's something we didn't want to happen. So let's look at a case where it doesn't happen, let's say with a covered call. Perhaps you buy shares of stock for 100 and you sell the out of the money 105 call for, let's say, 65 cents. So you're going to have positive delta if the stock falls, but if the stock rises, you're eventually going to have zero deltas because you've given somebody the right to buy your shares. And if you don't have any shares, then you've got zero deltas. So these are what your two risk graphs look like. Again, the black curve is expiration, the blue curve is today. So if the stock falls from this upper prices up here and heads down this way, you have delta 1. You're starting to get more and more on this straight line. And that's because you own the shares and your call option is going out worthless. So it's eventually converging on just long shares of stock. But if the stock heads this way, what happens? The blue line still has some positive deltas, but they're shrinking. And that's because we have negative gamma. We are selling off deltas. And if the stock price gets to this short strike or higher at expiration, we just go to delta 0. But we knew that, but we didn't go delta negative. But this is the way we anticipated that the strategy would work, and it's exactly the way that it worked. We go from delta positive to delta 0. Okay, so no harm done. However, let's take a look at a diagonal spread. This is one of the many ways where traders get into trouble. Let's say the stock is at 100 and you buy a 6-month $80 call. So this is fairly deep in the money. And let's say it's trading for 20 bucks. So at this point, it's trading at parity. In other words, the $80 strike plus the $20 price is exactly coming up to the current stock price. And then you sell the 1-month 105 call for 65 cents, just as you did for the covered call. Well, in this instance, you are using this 6-month option as a stock substitute because it's trading at parity. And our risk graph is now going to look like this. This is going to be our current curve. And as before, we have positive deltas coming up this way, but eventually fading out to 0. But again, this is the way that you are anticipating the strategy to work. But where traders get into trouble is they say, oh, I get it. You're just going to buy a deep in the money call as a stock substitute, and therefore I can make a cheaper covered call. And this is where they get into trouble. They look at that idea for this diagonal spread, or let's call it a cheaper version of a covered call, and they say, well, why should I spend so much for a 6-month option? Why don't I forget about this? Let me buy the 6-month $95 call for 8. And therefore I can spend 8 instead of 20. And I've got exactly the same position as the covered call writer, or if I had purchased this $80 call for 20. And the reality is they don't. Because by buying the $95 call, you end up with this as a risk graph. So what happens here is you have positive deltas as the stock rises, but look what happens on this side. You go to negative deltas. You see they flipped on you. They have rolled over from positive to negative. Now keep in mind that your zero line is right here. So you're thinking that this is going to behave like a covered call, that you're just going to go flat out here, and you use this diagonal spread, but because you don't go deep enough in the money, you end up with this problem. But it's a problem that people don't see until they just realize that they're losing money even though the stock appears to be in a favorable position, and they can't figure out why. And this is why your deltas have rolled over. So why does this happen? Well, remember on this side, you own a longer dated option. In this example, it was a 6-month $95 call. So your deltas are not 1. They might be 65 or 70. And so yes, you've got positive, let's say 70 here, but as you get closer to expiration of that short option, which remember is the condition we're using to create that black risk graph, those deltas are negative 100. So if you have plus 70 over here on the left in green, and you have minus 100 over on this side in red, on a net basis, you now have negative 30 deltas. And that's why you can start heading into losses. So this whole idea when we talk about look out for your deltas rolling over, or hey, you're going to run into a problem because your deltas will roll over on you. This is exactly what we're talking about, that they are flipping from positive to negative or from negative to positive. And there's really nothing wrong with that unless you don't realize that it can occur. See, if you're thinking in your mind that this is going to go flat and go to delta 0, then it's a problem. But if you realize that you have positive deltas on this side and negative deltas on this side, and it fits with your goals and your outlooks, well, there's nothing wrong with it. So just be aware that in past videos or any future videos, if I ever say, be careful of your deltas rolling over, this is what we're talking about. It's a very important concept that professional traders know all too well, and you need to be aware of it to make better trading decisions. And so for anyone who would like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.